Hi, it's Dave. Welcome. Today I'm joined by Gene Munster of Loup Ventures. It's been probably about 1.5 years since I had him on my show, and I'm wanting to invite him on. He has some opinions on the Fed, on the stock market, on Tesla, tech stocks. So there's a lot to talk about. Gene, welcome back on the show. How have you been?
I've been great. It's an honor, a pleasure to join you, and a lot of fun things going on for sure.
Yeah, definitely. I noticed on your Twitter account, actually I'll link to your Twitter profile in the video description. You've been following Jerome Powell's testimony this morning. What's going on? Anything stick out? Anything unusual? What's your kind of take?
Well, the piece that stuck out most is some commentary. There's a question from one of the lawmakers related to quantitative easement that was followed up with an inflation-related question, and they were needling around what is the Fed's posture going to be at their meeting. I believe it's the 25th and 26th of January, this upcoming next Fed meeting, which the market is obviously keen on. And Chairman Powell's comments were that we're going to move sooner than we had previously talked about. So I think that really stuck out with me. And of course, the market's been anticipating this. This is why the market was down big yesterday, kind of rallied back. And I think it's just, in general, the market's on ease. So I would put the context as I was encouraged to hear that Powell is now thinking that they're going to do something sooner. I was concerned that he may kind of hide, I guess, under Omicron. Omicron is very real, but hide under it and basically say we need to hold off on any sort of new policy adjustments around rates. But I think some of those are coming. And now my hope is just that the proper dosage gets delivered, and the proper dosage in terms of how fast rates are going up and how soon. Because for me, that's what the market needs right now, especially these tech companies. They just need clarity, and investors just crave visibility, and they need visibility that the Fed has made up their mind, and that their cadence is going to be something that they can sleep well at. So it's less about what rates ultimately do. It's more about just knowing what the Fed's going to do, and I hope we get that at the end of the month.
Yeah, I mean, you said it well, like clarity. Like 2022 is such a volatile or uncertain year because we don't know exactly what the Fed's going to do. It seems like we have interest rates as one basket. We have QE, the tapering of the bond purchases, which seems pretty definite right now. And then we have another aspect, which is quantitative tightening, which is, offloading some of the balance sheet. Of these, things, which do you think is the most kind of important or sensitive to investors? Do you think the number of interest rate hikes, or do you think it's, the quantitative tightening?
All roads ultimately lead back to interest rates, and so the number 2 and number 3 there have an impact on what rates ultimately will be. And so I think that is what's most important. And then the question comes down to where are rates going, and how does that impact these discounted cash flow models longer term? And so I think that is what's most important. When I put all of those together, I agree with you that those are the 3 factors. And in terms of what rates are going to ultimately do, the bond market has its own opinion, and they're moving well ahead of what the Fed's commentary is. And I think that the question I kind of played through too, it's more about visibility about what rates are going to do, less about what the absolute numbers are. And I suspect that the Fed's probably going to be chasing the bond market here, which means that the bond market's going to be moving up well ahead of the Fed doing anything. And so that rate number that I think is most important, we can look at it on a day-to-day basis. It's just a matter of taking the temperature down with investors and letting them know that the good old Fed's got things under control. And by the way, the inflation number that's going to come out, the CPI number for December, I think it's going to be another surprise. There's high expectations for it, but I think it's going to continue to be an aggressive number that's going to require this greater action by Chairman Powell.
Mm-hmm. On inflation, what's your view on it? Do you think it's transitory? Do you think 2022 will see, trending back to like 2%, or do you think there's something else going on and there is, actually real inflation that will linger?
I think it's going to linger. I think that we should get some pullback from it. Of course, it's been right around 7%. I think it's going to kind of drop back down. Maybe it's 3, 4, 5%, but I think it's going to continue to be at an elevated level. least for the next couple of years. And that's a pretty bold statement. The reason is that I think that, and the Fed said this on their December marks, and I thought they really nailed it. What we have here is a demand problem. And people are buying stuff. I mean, yes, there's supply chain issues that impact that, but the demand for things is really healthy. And I think that despite what you've seen is the bond market moving up in anticipation of these Fed maneuvers here, the bond market's been moving up, but yet demand continues to be strong. And so I think people are continuing to spend, and the housing market is kind of turning back on now after taking the last couple months of the year off, as it typically does. And the early indications is that pricing is going to continue to be up and be up strong. And so I think when you put all those factors together, I think you're going to continue to see inflation. I'm optimistic that these tech companies can counter some of that inflation, but I suspect that it's going to be at an elevated level unless there's what I would call draconian measures by the Fed, which I think it's unlikely.
Let's kind of unpack this, the impact of interest rates on the valuation of, let's say, tech stocks or even growth stocks. So on one hand, you have this interest rate hike that could impact, let's say, the discounted cash flow rates that you use to calculate valuation. But then on the other hand, if inflation is going up, it's possible perhaps that these tech companies raise prices if they have strong products, and it could be kind of made back up in earnings, right, with higher earnings. So what's your take on this? Like, how much does interest rates affect, the valuation of these tech stocks?
So I put a line between the near term, and I'd say that's over the next 3 months, versus the long term. And I think the long term, many of these tech companies, especially the biggest ones, are going to have a successful job of recapturing exactly what you talked about. And we saw that same phenomenon with Facebook pricing and Google ad pricing in 2021. Just this big spike up. And so advertisers are very sensitive to the opportunities that are out there and are moving their prices higher. And as you said, these companies are benefiting from it. You look at a company like Apple, they keep their pricing pretty stable. And so that would be an example of a company that definitely has pricing leverage, but probably isn't going to move their prices up as fast as Google and Facebook do on a day-to-day basis. When you put it all together, I think that over the long haul, I think a lot of that gap does get made up. And the numbers that we have, for every 1% increase in the Fed rate, you see a 10 to 20% headwind to earnings. And I think if you kind of would at least in terms of the discounted cash flow, not to earnings, but the DCF. So I think that these companies will, a lot of them will power right through it over the long haul. But I come back to the psychological effect of having the Fed out there meddling in the market and unclear what exactly they're going to do, that uncertainty. And so I think that from the fundamental perspective, I'm still optimistic that these companies can continue to move higher. I think that a lot of these tech companies are going to see that kind of inflationary benefit that outweighs the increase in the interest rate. But again, there's a psychological piece that needs to play itself out. It needs to flush itself out. And that's why I just hope for the worst when it comes to Fed commentary at the end of this month, because the faster we can get that flushed out, the more quickly investors can start focusing on what you just described, which is earnings upside related to this inflationary environment.
Makes sense. So you talk about, let's say, for every 1% of interest rate hikes, you're seeing like a 10 to 20%, let's say, hit in the discounted cash flow valuation, approach. So what do you say to those who say, like, hey, the Fed can't raise interest rates beyond a certain level just because it'll invert the yield curve, right? Like, we're in a super low long-term interest rate environment. Maybe the Fed maxes out at, let's say, 1.5% or something before, just goes haywire and moves us into recession. And so with that, let's say, you have a 1% or 1.5% max. So the cap to hit valuation isn't, unlimited, of course, right? There's some type of restraint. So how do you view this? Is this something like, should investors be concerned about this, in terms of, this is going to hit my portfolio, my tech stocks are going to, maybe go down with interest rates hikes? Or do you just kind of weather it through if you're a long-term investor and say, hey, these are strong companies, as you said, their earnings will come back, they'll adjust with inflation. And this is just like a temporary, maybe headwind that's unclear, uncertain how things turn out. What's your kind of take on this?
Well, I think that by the way, those rates and that inverted yield curve conversation, it's a dynamic one, because on the one side, you don't want to invert the curve. On the other side, you don't want to create what happened in the late 70s and early 80s in terms of the inflationary environment. And so there is a give and a take there. I think that as far as the near versus the long term, and from a near term perspective, I'm still cautious. I'm still of the belief, and when I talk about near term, I talk about the next 1 to 3 months. Again, I hope we get some good clarity at the end of this month. But I think that there can be still an emotional impact to these companies, even if it's moving to that trend that you talked about, that 1.5 basis points. And from our fund perspective, our fund is more than half in cash right now because of that. Wow. And so we're taking a pretty conservative approach to it. Again, if we're okay giving up some of a market bounce here, or the hope that I have is that the Fed comes out strong at the end of the month and is more aggressive, and the market actually responds positive to that. So my first and foremost, I want to know how I feel. I guess look at our portfolio and would suggest that I'm still conservative. That said, I'm a big believer in these companies, and I think that this commentary that there's going to be some opportunities. I don't know what it means, like generational wealth opportunities. What that does that mean once in a decade, or it can change your life? I'm not saying we're at that point. But if you just step back and I think look at what has happened, especially in mid-cap growth, some of these transformative companies over the past 6 months, and I think that there are going to be some huge opportunities. And so I'm still a believer in the long term. The idea of just owning things and don't worry about timing the market, we want to be a little more active than that and just be sensitive to this alignment that we still think needs to happen between what the Fed's thinking and what investors are thinking.
Mm-hmm. Mid-cap, let's say growth, it seems like a lot of growth companies, especially those who don't have, let's say, either positive cash flow or let's say strong profits, they're getting hit big time in the past 6 months or so. Some are down like 70% or more. Do you see this as an opportunity to start picking up a position, or do you just kind of say, hey, I'm going to hold off a bit to get some more certainty from the Fed before kind of piling into some opportunities?
So we do see opportunities even with this background, and the way we kind of anchor our thinking is we have a methodology called the reverse DCF, where we go and look at a current valuation of a company and we can factor in what the expectations are for investors for growth. We're believers that for tech stocks to work, they need to exceed investor expectations. So the better sense that we have of what's currently priced in. And the way we internally think about this is just setting aside all the noise around what's going on with the Fed. We just have a list of 50 companies that we love, and we're waiting for those companies to dip into the buy window within our reverse DCF. So we have been being strategic and picking off some of these. It has been just that. It's been it's most strategic. So I think that there is some room for that, and I think ultimately we still want to err on the side of I think safety related to what's going to happen with the Fed.
Got it. Of these like 50 companies you have your eye on, what are there some like kind of examples, like maybe top 3 or so that appeal or intrigue you the most?
Sure. We really want to focus on where the world is going, and I think this concept of stepping back and thinking about which companies are going to power that change. Sometimes where the world is going gets caught up in the hype. Sometimes the hype is justified. In the case of the companies that we love, there are companies based, like, for example, the metaverse is a theme that has gotten a lot of hype, but I think the substance of it still is grossly underappreciated. And we think that the first mechanism for monetization around the metaverse will continue to be, I guess it's not the first, it currently is around gaming. Roblox is a great example. We do not own Roblox, but we do own TakeTwo. And that is just, recently also with their on the pullback here with their acquisition of Zynga. The stock was down significantly on that. That for us is an opportunity. Also, there is the world's biggest product cycle. For years, I've covered tech companies going into product cycles. I'm gonna date pretty much everybody here, but I used to cover companies like Adobe and Autodesk, and it's pretty simple. You'd buy those companies when they would blow up ahead of product cycles, then you'd sell them when they would release the product cycles. You just trade them. It's incredible how well it worked. In the case of TakeTwo, we have the mother of all gaming upgrade cycles, supposedly not till 2025 with the next version of Grand Theft Auto. So that's one example of a company. Another is Coinbase. That is, we view that as the bank of the metaverse. We don't want to invest in a specific currency, but we do think an exchange to take finite money into the metaverse is a massive opportunity. So those are a couple example companies of the kind of we see as opportunities here in the pullback.
Yeah, interesting. I'm wanting to, let's say, dive into a bit into Tesla. So I know you've been a big advocate on Tesla's growth potential and future. What are your 2022 expectations, like in terms of just whether it's deliveries or gross margins, or overall, can Tesla beat expectations, which are quite high going into the year? What's your take on Tesla 2022?
So this is the year, of course, of deliveries, and that's what people are going to be focusing on with Tesla and Rivian and Lucid, and we want to hear more what Ford deliveries are with the electric F-150, for example, and Mach-E. And I think that the way I think about companies is I refer to them as pressure points, that every company really has one or two things that really matter. And in the case of Tesla, I think that it's overweighted to one pressure point. I think it is on the delivery number, as obvious as that seems. And the street estimates, I haven't seen them after they've reported their strong December quarter, but I suspect that the in-print numbers are going to be around 1.3 million deliveries, and that would be up about 45% from 2021. And the whisper numbers, of course, you got to beat the whisper number, is probably higher than that 1.3. And so to answer your question, I think it's going to be, I made a prediction that Tesla would be, at the time the street was at 1.2 million, it would be between 1.2 and 1.3 million for 2022. I think that that's ultimately going to be conservative. On the gross margin side, I think they just need to maintain where they're at. If they can continue to grow units at 45%, they had so much improvement in gross margin over the past 2 years. I think investors have some level of confidence that they can show margin expansion towards more of a tech-like company. And so I'm encouraged that just a sustained gross margin level, I think, would be viewed as a net positive. It reminds me a little bit of Amazon. They first were thought to be profitless prosperity, and then they would show for a year and a half of some margin expansion, and then they would pull back and kind of surprise investors on the downside as they went into investment mode. But the fact that they went through a period of expanding margins gave investors some confidence that they could do that in the future. And I think all the lessons, all the good things that happened with FANG are really benefiting Tesla shareholders here, because I think that it gives the company some room to, again, maintain gross margins and still be viewed as moving in the right direction relative to becoming ultimately a tech company.
Mm-hmm. On gross margins, what's your expectations kind of long term? There's a lot of analysts who actually think that Tesla's margins, let's say in 2030 or so, will be around where they're at right now, or even lower, because they're selling a lower cost car. But on the flip side, there are some people who say, like, hey, this is a company that is going to have lots of add-on services, software like FSD, autonomous driving, et cetera, that can boost their margins over time, even if they go downstream. And so some people are expecting over 40%, margins, or even higher. What's your take on gross margins? Are you leaning on more of the kind of more conservative side, or do you think Tesla can expand gross margins significantly over time?
I think that they can expand, and I'm more in that camp of, I would say, at 40 or slightly below, fractionally below that, and then use Apple as a good benchmark. Apple, of course, is hardware, software, and services, and I think that's ultimately what Tesla is. And there's this, debate about whether Tesla's a tech company or a car company, and from my perspective, it is a device on wheels, and the device on wheels has opportunity for services on top of it. The big service that gets talked a lot about is related to FSD, but the company can get into other services. You could have in-app entertainment opportunities. Those are probably small relative to like an FSD opportunity, but that is, to me, high value, high margin. And I think that the recent price increase of FSD was more window dressing that's coming up here, I guess, from 10 to 12,000. I think that's more window dressing than like substance behind any sort of massive demand. But I think that the concept of really increasing the utility of a car, and as we think, just to finish the thought too about, yes, I think Tesla's going to introduce, the Model 2 will come out, and that will probably, I think, stabilize what I think ASP is kind of in that 45 to 50 range long term. And the reason why I believe that is I think that there is upward pressure on car pricing more broadly. I think the rest of auto is in a tighter spot than Tesla, and for them to even consider being viable for the long term, they're going to have to continue to keep their prices up as well. So I think the concept of this mainstream car price being $32,000, $34,000 right now and going up a few percent a year, I think that that's going to go away, and I think it's going to gravitate, unfortunately, to car pricing being right around that 45,000, which gives Tesla room to sell some higher ASP services like FSD and continue to maintain share.
Mm-hmm. I mean, why do you think? So you're saying kind of car prices get reset at a higher level in a sense. Is that mostly inflation driven, or is it just something fundamental about how people are viewing their cars, or what's behind that?
I think part of it's inflation, and maybe just a quick snapshot. There is some craziness going on in the new and used car pricing market. I don't want to go and quote numbers that are a couple months old here, but I think that they have been surging well above that kind of low $30,000 range before the pandemic. So there's this inflationary piece to it, but also I think that there's a utility piece. And you think about what's happened with smartphones, and it's easy to build utility, and it's been easier for Apple to charge on average $700 for a phone because the amount of time we use it, the utility, it is more than we realize throughout the day. Car's a little bit of a different dynamic because you don't really use your car as it stands that often during the day. But there is an opportunity. I mean, Tesla's talked about this too. I have a lot of respect just for their radical approach to things, but this concept of an expensive asset that you have that's underutilized, and the eventual ability to, whether it goes into the robo-taxi fleet, not everybody's going to want to do that, probably a very small percentage of people, but that's an example. Also, the safety piece around it, I think people will value that. Don't get me started, Dave, on talking about car safety, because cars are not safe. And the last piece, I think just the overall experience to be able to long-term not even think about driving, I think it is quite powerful. I do need to inject that my strong belief that the cars eventually will all be autonomous. Loup's Doug Clinton, worked with Doug for a long time. He has a belief that that's never going to happen because you have people love to drive, and politically it's going to be impossible to mandate full autonomy. But when they would put it all together, my belief is there's going to be more utility out of a car, which is also going to drive that ASP higher.
Mm-hmm. Makes sense. What's the biggest risk for Tesla, you think, this year?
Well, aside from the, I guess the obvious about what's going to happen on the component side that could end up creating a fracture potentially in those delivery numbers, what is the biggest risk? It's actually concerning to the stock that there's not an obvious one, because usually you want something really negative that can kind of balance the scales. I think there's probably a risk of people just thinking that it's not moving in fast enough in the right direction. I talked about the margin expansion, and this being a year where we're going to see kind of flatter gross margins, and maybe there's risk that I'm just misreading the market and investors want more. So I guess there's that piece, there's the investing piece of the risk. So just to be clear, is that my belief that maintaining gross margins is enough. Maybe I'm incorrect on that. The second, from just a fundamental standpoint and competition, I wish I had a great question. I think I think it's going to be a tough year, still a tough year for traditional auto. I think the amount of I mean, it's hard for me to put into words like how backwards I still think auto is. I don't even remember the car company, but I recently saw an ad for a car that was a woman got a gas card for a gift, and she had to get her father-in-law, I think, a gift, and they were rushing around in the car trying to get the gift, and they just decided to re-gift this gas card to their father-in-law, and because they had this, maybe it was like a Toyota hybrid or something. And the crazy part about it is, I believe it was an ad for a hybrid that still takes gas. And when I think about just this concept, like traditional auto is like not only advertising these, but they're like investing in these products. And we had a meeting with a large automaker. It was a long time ago. It was a couple of years ago. And they said that if they don't start moving fast, and this company has not moved at all, if they don't start moving fast, just because they've been around for 70 years doesn't mean they'll be here in 70 years. And I thought that was very telling. So from a fundamental standpoint, from a market share standpoint, I still think Tesla has the best value for an electric vehicle. And I think it's going to put other car makers in a tight spot this year.
Mm-hmm. Yeah. Yeah, I mean, when you think about it, because you have such a long background with Apple, and you've been, covering them for such a long time. It seems like, one of the advantages of Apple is this integration where you have the hardware and the software, including the chips nowadays, but it's this complete experience where they're almost religious in the end user experience. It's got to be like perfect, and they'll do whatever it takes, to make that user experience what it is. And it seems like Tesla has emulated some of that business model where it's like, okay, like the whole shopping experience is so crazy terrible with, a new car dealership typically. But Tesla has like completely revamped it. They've gotten rid of all these options too, and it's just made it so simple to buy a car and to get it, charged or serviced, or, just the whole software updates. Everything is just this integrated, tight system because of the end kind of value proposition to the user, which is it's going to be the best experience possible. Like, do you see kind of, similarities with Apple and Tesla, especially, since you've covered Apple so long? And what's your perspective? Like,
I think, they both got it right. And I think one of the ironies of them getting it right in terms of vertical integration, and they do it at different levels. I think Tesla's even more vertically integrated than what Apple's doing, because they have the manufacturing piece, and they have tooling for different parts too, but they're even more vertically integrated. But that concept of vertical integration, it's so hard, and just still, I think, underappreciated. Apple for a long time was penalized by investors for having a hardware business. The reason is that there was scar tissue around other hardware companies that blew up, whether it was Sony or Nokia or BlackBerry, and that eventually hardware is a hit-driven business and it just kind of goes away. And in reality, Apple was hardware, software initially, and then they've added that third services piece on. And I think Tesla has a lot of the same similarities. They've got a lot of people that have worked at both companies. They've poached between the companies. I think at the core technology piece, they're culturally very similar. At the highest level, they are very different, I would say, or at the management level, they're very different, where Tim Cook has, I think, this embedded fear, understandably, that he doesn't want products killing people. As harsh as that sounds, I think that is a very real concern, just given their high-class brand. And then on the other side, you have Tesla introducing an FSD option for more aggressive driving, where it will do rolling stops. I mean, so I think that there's a lot of similarities between the companies, but still, from a leadership standpoint, there's a lot of differences.
Got it. With Apple, like, there's a lot of people who miss the boat on Apple for various reasons, right? There's this constant kind of feeling that, oh, the valuation is too high, right? It's always too high. So people, they end up chasing, or not chasing it, but always like saying, oh, it's too high, then they never get in. Or there's oftentimes confusion of exactly what the product, how strong the product, how sticky it is, right? How what the future of the product could look like. But I'm curious, like, because a lot of times it feels like with Tesla is the same thing. It's like this, the common criticism is valuations too high. What would you tell people? Let's say, I don't know if you have kids, but, or let's say people that young people that, let's say you have a young person who's like, you really wanted them not to miss the next great generational company, let's say, and you've seen throughout your history, throughout your career, people missing, with Apple or with Tesla. What would be your kind of key advice, to this young person? Like, are there any skills they can develop? Are there any like places they can get knowledge? What are the things they can do so that when this next opportunity comes around, that they won't miss it? They won't be, blindsided by all of the noise around.
I think it's straightforward, and my guess is everyone does it at some level, but it's just having a sense about where the world's going. And in each of these companies, they've had different products out, and I think people just across the investment spectrum have had aha moments where you realize that this is just better. I had one a few months ago with Tesla and the FSD beta, and so it's a company that we've been positive on for a long time, but there was kind of like this renewed piece, like this is it was rough, but I just had a sense like something bigger is going on here. And I would just say is you have to just lean into that kind of your intuition around it. And in the case of so that would be and you can still, some of these big companies can have moves and can continue to go higher too, but you have to figure out kind of what's that next thing. In the case of Apple, it's going to be what are they doing around the metaverse and the headsets that they're not going to sell very many headsets for the next 2 or 3 years. I mean, it's a long ways away, but the potential of essentially a world that's Ready Player One-esque, I think is very real, and I think Apple is going to play a role in that, or with Tesla, with FSD. So to answer your question, it's these kind of moments, and I've been wrong. Like iBuying is a moment, and we'll see how this plays out. Open Doors and investment of Loup. It's not as fun and as glamorous as whether it's the iPod, iPhone, or some mixed reality glasses. But when you just hear people also just have like other people who have just kind of experienced the product too. You have an experience, and a light goes on for you, and someone else has an experience, and the light's going on for them. You're probably onto something.
Interesting. It's kind of this catchiness, right? People, it like opens up a whole new kind of experience or view on something, perhaps. Yeah, I mean, the first time I used the iPhone, it was revolutionary. I was like searching for something like that. And I was like, the first day, in line, just waiting for like all day for this thing.
Awesome.
Yeah, and it was just like you knew this was the future. It was just like, but then the funny thing is like most people like ridiculed it, saying it's like this piece of jewelry that no one will ever buy because it's too pricey.
Too expensive.
Yeah, right? That was a big kind of I don't know what it is. It's like mental block in a sense. It's like this prejudice against something that for some people is just so obvious. But yeah, it's definitely interesting.
I would say this too, that the market will send signals to you that you need to factor into. In the case of the iPhone, you're right, is people thought it was expensive. Kind of a fun fact is after the first weekend that the iPhone was originally introduced, it would have been 15 years ago this coming June. After that first weekend, AT&T was the only carrier, just in the U.S., that they missed their numbers. It was like the whisper number was like 350,000 units. I think they do. I think Apple, they'll do 280 million, so they do like 1 million per day now. But 350,000 units, they did 250, something like that. And I remember talking to investors, and one investor said, "Dead on arrival." And I think you see some of that. I think you see some of that with FSD right now when. Some of the noise and it's some of the stuff that the car does is bad, no question, but I think it's moving in the right direction.
Yeah. I want to ask you about Apple Car. I know you've talked about Apple Car as something that obviously isn't guaranteed, but it seems like lately with Mark Gurman, with his Bloomberg article, it shows like some renewed interest and energy regarding their autonomous driving plans. It looks like they're trying to go more, autonomous driving, a car without the steering wheel. When I look at Apple, it just seems like they're like a notch or two below Tesla in terms of execution on the car front and autonomous driving, maybe even more. But they've had so much talk and so many plans, so much change of leadership. And it just seems like when you're in a field that has a killer company that's executing at a super fast pace, you can't afford to make those type of mistakes. Like you can't afford to have 2 or 3 years of bad management and failed plans to compete. And it seems like, Apple's, the market is just so big. It's such a huge addressable market that they just can't ignore, but yet they've been plagued with so many, mishaps. What's your take? Can Apple come up with a car? Can they compete with Tesla at all? Like, what's your opinion?
Agree with your lead in. I think there's more action there. I think Mark Gurman does great work, and I think he's reporting accurately that Apple wants to do this. That doesn't mean they will do it, but they currently want to have a car. As far as being late to the party's just kind of, or it's the party's over, the party's taken off, they've missed some sort of escape. It's definitely a much harder, they have a much harder job ahead of them today than they did 3 years ago if they would have had things aligned better. There's no question about that. I do think we're still just so early in this, and I'll just go back to the market share numbers, whether it's EV at 3-5% of total vehicles, or you look at autonomy at basically zero today. There's a lot of learnings that Tesla is gaining every day, every mile. I think that advances their ability. I don't think that it's a one player take all either. Agree with you that it is a massive TAM, and I mean that's the exciting part about auto is it's about as big of a TAM as you can get, and so I think that they're not too late, and I think you could have built a kind of a similar argument on other examples of Apple products that they've gotten into when they weren't first to the market. They're a little bit later than they typically are here. I agree with that, but I think there's still so much. And really, the basic concept of a car still is largely unchanged. There's still a driver in it, still 4 doors, typically. Pickup trucks, love pickup trucks, just got to pick up. But I think that there's still an opportunity really to have that iPhone-like experience when you first got it and you get into a car and say, wow. You get that with Tesla, but I think there's still a whole nother level that can happen, and I think Apple's in a good position to capture that.
If Apple is kind of shifting more of their plans and hopes to this more autonomous driving piece of the picture, how can they compete against a massive fleet in the millions that is collecting data, not just kind of regular data, but these edge cases, which are really difficult to acquire? But Tesla is acquiring these edge cases at a huge level that no kind of small company or a company that doesn't have that type of fleet can match. And if hypothetically the quality and the amount of data and these edge cases will determine the performance, right, of full self-driving. I mean, what's your kind of optimistic take on how can Apple catch up to that?
I think about this, what's going to happen in auto is this is a 20 to 40 year transition we're going to go through. And I think that I would agree with that Tesla has advantage today. I think that the mile is, there's a debate whether or not what you just described is accurate because there's simulated miles. I think it is real. I think that actually having road miles is something that benefits Tesla's neural network, and I think that that's going to continue to give them an edge. Where I think Apple comes in is there is a number, I don't know what the number is, but there's a number of vehicles on the road. Let's call it that there's, I'm just off the top of my head, I'm going to guess there's probably 3 million or so Teslas on the road right now. Let's say that Apple needs to get to 1.5 million of those, and it might take them a decade to do that. Again, we're all operating under a belief that this is going to happen. I need to stress that. But I think that there is, I think you can get there is my point. And they have some real work to do. I think you need real miles. I don't think that it comes to Apple licensing technology from Tesla. This is not a investment recommendation. It's just my opinion that Tesla can be a $2,500 stock in the next 5 years. And I think that's based on what you just described as a big advantage. Yeah. But I do think that there is a place that underneath what Tesla's doing, which Apple can really land and expand. And I think if they get enough vehicles out there, they can gain a lot of the same insights and create a safe and compelling autonomous system.
Mm. Do you think Tesla can become a more valuable company than Apple? If so, what year do you think that might happen?
Well, if Apple gets into auto, I think that is highly unlikely. I think if Apple doesn't get into auto, at what point would Tesla be bigger? I'm talking about 5 years at $2.5 trillion for Tesla. So, and we're above that for Apple today. So it's probably 10 years out. I mean, they're going to have to get the solar up and going and the battery business and probably need to get into their insurance now, expand that, and get into robotics. They got to do several other things. But I would say this, I think it's on the table. It's something that you just can't dismiss. And so I think that the opportunity is just that big still within the markets. Tesla's going after renewable energy and autonomy, and what Apple's going after, that we could see a long-term battle. My guess is it's probably going to come down to those two companies. I think it's going to be Apple and Tesla really fighting it out for the largest market caps.
Yeah. I'm not going to say this is going to happen, but there's some people, and I'm still not, really resolved on this, but, let's say if Elon, does, and Tesla does solve, let's say, level 4 type of level FSD, and let's say in 2023, next year, let's say Tesla reaches 40% gross margins, which is unheard of. Like no analyst has even, near those type of margins, even long-term perhaps. But let's say hypothetically, this thing takes off beyond what most analysts even are conceiving. And Tesla's able to, charge, an uptake, take rate goes up, they're able to charge, et cetera. So they reach 40%. Do you think there's a chance Tesla could become the most valuable company by the end of next year if that happens?
The scenario that you just described, the number that came into my head just off the cuff was this. That's $2,000 stock, $2,500 stock, something like that. I think that would be really remarkable if they had full FSD available to the public at the end of 2023 and they had 40% margins. But remarkable things have happened with Tesla, so you have to respect that this can continue. And so, do I think that would be the moment that Tesla could inch ahead of Apple? I think that's unlikely. It would close the gap undoubtedly. And I think from Apple's case and the investor, the more that investors, all the mojo that they're seeing investors see with Tesla, the Apple investors want the same thing. I mean, I hear from them, they want it. And I think that Tesla could counter some of that gap Apple could counter some of that valuation, that closing of the gap, I think, if more just leaks out. I think this is going to be a year we're going to get more and more leaks from Apple in the car. And I think that kind of keeps Apple safely ahead. I think that crossover point, if it does ultimately happen, I think we're still 5+ years away.
Got it. Gene, it's been fun and fascinating talking with you about the Fed, interest rates, the market, Tesla, Apple, so much stuff. It's been super helpful. I'm sure it's going to be super helpful for all those listening as well. I'll go ahead and link to your Twitter profile in the video description and also to Loup Ventures. Any other places where people can follow your work? I know you also have an ETF as well, and people can track that. It's on your website. Any other kind of links or resources people can you can point people to?
You covered it. Appreciate it very much, Dave, but you got all the bases covered. It was just a joy to join you.
Cool. All right, Gene, thanks a lot. Have a great day.
Thank you.